You're sitting at a gas station. The harsh neon light flickers, casting an eerie glow across the pavement. $7.79 a gallon. You blink, thinking it's a trick of the light, but it doesn't change. The number stares back at you, cold and unyielding. The trucker behind you slams his door with a loud, almost desperate thud. He mutters something about skipping lunch just to afford his next fill-up. But his frustration is nothing compared to what's unfolding far beyond your view. Hundreds of miles away in Ottawa, a cabinet meeting just took place. One that quietly, but fundamentally, changed the world's energy balance. And Washington? They were completely blindsided. Canada's decision to scale back oil exports to the US, a supply worth $13.3 billion in 2024, according to Statistics Canada, was not an act of anger or protest. It wasn't some spontaneous defiance. It was the result of years of growing tensions, trade disputes, diplomatic breakdowns, and a fundamental shift in priorities. Washington's repeated threats to impose tariffs on Canadian electric vehicles, rare earth minerals, and other vital exports created a climate of mistrust. And Canada, once a reliable partner, began to pivot. Behind closed doors, Ottawa started quietly diverting oil, redirecting pipeline volumes away from US refineries and toward Asia. The decision was deliberate, calculated. Bloomberg reported that just days before former Prime Minister Trudeau met with executives from India's OMGC and China's CNO, Canada's Energy Minister Jonathan Wilkinson authorized a shift in oil exports. The American government didn't see it coming. Even though a February intelligence report from the Congressional Research Service had warned of the risk of energy displacement from Canada, US officials were too preoccupied to act. What followed next? A tectonic shift. Since Canada's decision to cut its exports, US crude inventories have dropped by 11.4 million barrels in a mere 3 weeks. The sharpest decline the country has seen since the devastation of Hurricane Harvey. At the same time, gas prices across the US have surged from $3.38 to $4.81 in just 10 days. In California, prices are cresting over $5.25 per gallon. This isn't a temporary spike. This isn't just an inconvenience. This is a systemic tremor rippling through every level of the economy. Midwest refineries, which depend on Canadian heavy crude for over 60% of their feedstock, are barely functioning at 71% capacity, down from 89% just a month ago. Refineries across the US are ill-equipped to process anything other than Canadian grades of oil. The costs of substitutions are astronomical, and the inefficiencies are staggering. Meanwhile, in Michigan, steel manufacturers are reporting cost increases of 18 to 22% on oil-derived inputs like coke and lubricants. Contracts are being delayed. The entire industrial landscape is cracking. Diesel deliveries to grocery hubs are faltering. Food prices are soaring, not because of a drought, but because of an energy crisis choking the supply chain. And this is just the beginning. Behind the reallocation of oil lies a cold, hard calculation. China and India are paying premiums for Canadian oil, offering 8 to 11% above the market price for long-term contracts that come with no politically sensitive strings attached. Reuters reported that China's state-owned CNU just locked in a 15-year deal with Canada for 325,000 barrels per day, oil that was once earmarked for the US Gulf Coast. Indian Oil Corp is doing the same, signing its own multi-year deal, leveraging Canada's upgraded Pacific infrastructure. Asia is opening its doors to Canada, while Washington stands still, embroiled in its own economic battles. Meanwhile, Washington continues to focus on retaliatory trade tactics, like anti-dumping investigations into Canadian solar panels and batteries. But the world, especially Asia, is moving on. While the US is obsessed with tariffs, Canada is strategically repositioning itself. In an internal memo, Canadian Deputy Minister of International Trade Rob Stewart confirmed what had become undeniable. Relying on one increasingly volatile partner was no longer an option. Canada was diversifying, and it was not ideological, it was existential. The United States had pushed Canada too far. As the shift from US exports continues, the real strategic impact is only beginning to unfold. Canada's Trans Mountain Expansion project is now fully operational, capable of shipping over 890,000 barrels per day directly to global markets. By bypassing US transit routes entirely, Canada has opened the door to being a major player on the world stage, free from Washington's influence. And the world is noticing. Major European companies like Germany's E.ON and Japan's JERA have already signed preliminary agreements to lock in Canadian LNG and crude supplies through 2040. Canada is becoming a preferred partner not only because of its reliability, but because of its cleaner, more sustainable ESG ratings, which qualify for EU subsidies. As European energy grids scramble to replace Russian gas, Canada, cleaner, reliable, and closer, has become a key player. Asia, with its insatiable energy demand, is benefiting from shorter maritime delivery times through Vancouver, further cementing Canada's strategic value. U.S. influence over global oil benchmarks and energy disputes is eroding as more and more of Canada's oil bypasses American-controlled routes. If Washington thought OPEC was a challenge, it hasn't yet reckoned with a friendly neighbor-turned-independent energy broker. Goldman Sachs' March 2025 report warned that if the Canadian supply disruptions continue into June 2025, the U.S. could face a 0.8% contraction in GDP in the second quarter alone. The ripple effects across the manufacturing, transportation, and utilities sectors will be devastating. The Federal Reserve Bank of St. Louis issued warnings about localized grid vulnerabilities. In Illinois, KMED has already triggered its emergency procurement plan to secure alternative diesel sources for critical services, like hospitals. Meanwhile, chemical manufacturers are seeing operations grind to a halt, operating at just 63% capacity, compared to 88% in January. Treasury Secretary Janet Yellen has openly warned Congress. We are not currently in recession, but we are dangerously close if this energy crisis remains unresolved. But the real danger here is not just the immediate economic strain. It's the long-term geopolitical consequences. The growing divide between Canada and the U.S. is no longer a distant possibility. It's happening right now. As the tensions mount, Washington's attempts to reassert control are backfiring. Trump's March 25th proposal to impose a 100% tariff on Canadian autos, after a fiery Oval Office meeting, sent shockwaves through the market. Ford and GM shares dropped 7.2% as investors feared the economic fallout. But the bigger issue wasn't just the trade retaliation, it was the hidden military consequences. Canada is not just a trading partner. It's a key supplier to the U.S. military, particularly in defense contracts. Lockheed Martin's F-35 fighter jet program, valued at $19 billion, relies on Canadian-made parts for the jet's landing gear and fuselage. A move to cut off Canada could delay at least 18 jet deliveries, crippling U.S. Air Force readiness and undermining NATO's operational effectiveness. This is not just about oil and trade. This is about military readiness. And Canada has just shown that it's willing to move in a different direction. Since January, Canada has signed $6.3 billion in new arms export deals, leaving the U.S. out. These deals, with countries like Indonesia, the Philippines, Ukraine, and the UAE, represent a massive pivot away from U.S. military reliance. Canadian defense firms are no longer beholden to Washington for approvals or technology. Ottawa is investing in its own defense infrastructure, with a $2.2 billion AI-driven R&D cluster aimed at mirroring the likes of Israel's Rafael or France's Thales, without U.S. involvement. The goal is clear: sovereignty, not subordination. Canada is no longer just diversifying its trade. It's decoupling, repositioning itself as a powerful, independent player in a multipolar world. The world is watching, and it's seeing that the U.S.'s grip on its northern neighbor is loosening. As Canada moves away from the American orbit, its defense, energy, and financial ties with Washington fray further. This is no longer about minor trade disagreements. This is a tectonic shift in global power dynamics. When Trump's bombastic Oval Office outburst sent markets into chaos on March 25th, it was more than just a political tantrum. It was the tipping point, a signal that U.S. governance, once a pillar of global stability, was slipping into chaos. The VIX spiked, the Dow plummeted, and oil surged past 12 a barrel. The deeper risk here isn't just volatility, it's what this instability reveals. America's diminishing ability to wield power through economic coercion. Once a global superpower with unmatched influence, Washington's grip is now slipping. And if Canada, once a reliable, integral partner, can walk away without consequence, what's stopping other countries from doing the same? This isn't just a dispute over pipelines or tariffs. This is the unraveling of the post-Cold War order that held global power structures in place for decades. Each oil contract renegotiated, every jet deal threatened, and every pivot toward China signals the collapse of a system that once seemed ironclad. The U.S. is no longer the undisputed leader of the global order. The alliances it built through oil, defense, and the dollar are now in flux. They are no longer guaranteed. They're being negotiated, and right now those negotiations are turning against America. So the question is, if Canada has just rewritten the rules, who's next? Let us know in the comments. Because what comes next won't just challenge American power, it could redefine what power even is. Stay tuned, because this story is only just beginning. And don't forget to like and subscribe. You're not going to want to miss what happens next.